This is just a quick summary of when do you capitalize something and when do you expense something. Really, this is the one I would focus on right here. Okay, you're going to capitalize it if it provides benefits in the future. You're going to expense it if it provides benefits only for the current period. Okay, so this I would write down, make notes of it. Very important that you understand this. Okay, when do you capitalize something? When do we expense it? Capitalize, remember, it means when are we going to recognize it initially as an asset and then slowly amortize or depreciate its value. In expense, we just take all at once, right? So now we're going to talk about the amortization, depreciation, and disposal of assets, right? This is the fun part. This is the part that accountants love. This is allocation, right? Us nerdy folks in accounting, we love to allocate things. We live for it, right? So let's talk a little bit about what is depreciation. Well, depreciation is the allocation, such a sweet, sweet word, the allocation of an asset's cost as an expense over time. Okay, we've already done this. We talked about this in like chapter 3 and chapter 4, right? This is, you bought a vehicle, you think it's going to depreciate at $500 per year. Every year you recognize a $500 expense. Okay, all this is doing up front is it's telling you we paid this $1,000 up front. Okay, we think that over the next 4 years, if we're going to use it up until it equals 0, so every year we're going to have a $250 expense. Okay, we're using the benefit of that $250 of a benefit of this initial $1,000 cost. Okay, this is what depreciation is, right? So how do we actually record depreciation? Well, again, we've done this before. We've done it since chapter 3 and chapter 4, I believe. So let's say, for example, Starbucks pays $1,200 for a piece of equipment. Let's say it's an espresso machine. They tell us that the service life, now, again, you're going to want to start picking out these key terms, service life of 4 years. So that equals 4. What are we going to do? How do we expense this? Well, we paid $1,200 for it. It doesn't tell us anything outside of that. So we've got $1,200 as our cost. We know that we're going to use it for 4 years. So we have a $300 yearly expense. Okay. We can see that right here. We're going to increase an expense every year by $300. We're going to decrease that equipment net. Remember, they're saying net because we've got accumulated depreciation, right? And this is our journal entry. We're going to increase our depreciation expense. We're going to increase our accumulated depreciation. Remember, this accumulated depreciation is like a storage bucket of, money that we are putting into, every year. We're going to put an extra little bit of money into this bucket, right? So that's what accumulated depreciation is. Until this bucket equals $1,200, right? And then we'll stop. Okay? So again, just a quick refresher on depreciation and accumulated depreciation. So every year they're going to do this. After year 1, less accumulated depreciation of $300. So now our book value is $900. After year 2, our book value is $600. Why? Because we have $600 in our accumulated depreciation account, right? Okay. Notice the equipment cost never changes. Please, 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 please notice this. Okay. Take note. Your actual equipment cost is never going to change, right? This is the historical cost principle. Okay. Our equipment cost remains the same. It is our book value that changes. So, in financial accounting, there are 3 very popular common methods that we use to depreciate long-term assets, okay? In this course, we're only going to utilize one of those, and it is the most used method. It is the straight-line depreciation method. Why do we use straight-line depreciation method? It's the easiest. There's less chance of you making a mistake with this, okay? This is basically just going to say, take your historic cost, divide it by the number of years you think it's going to be useful. That is your expense every year, okay? Unlike these other two where you have to do additional calculations, that is the only calculation you'll ever have to do with straight line, and that's why we use it in this class. So there are a couple terms that we will throw around when we are talking about depreciation. The first of them is service life, also known as useful life. Be familiar with either one of those terms. They will use them interchangeably in your homework. I will use them interchangeably when I'm speaking with you. Okay? The service life or the useful life is just simply the estimated use the company expects to receive from the asset before they dispose of it. Now, that does not mean that if they say they've got a 10-year useful life or a 10-year service life, that after 10 years they get rid of the asset. I believe we talked about like the trucks from the 90s that the people at O'Reilly's are still driving around as delivery vehicles, right? I would imagine that their useful lives on their book, if you looked in their 10Ks, was not 35 years, right? It's probably closer to 15 years, maybe 10 years, okay? The other one is residual value, aka salvage value. Again, be familiar with either one of those terms. They will be used interchangeably by myself. They will be used interchangeably by your homework. This is essentially the amount that the company expects to receive if they sold the asset at the end of its useful life. So let's say O'Reilly's decides to sell one of those sweet Ford Rangers, and they think that they can get $1,000 for it at the end of its useful life. That $1,000 is their residual value. Okay, that is the salvage value. The third one that we'll talk about is depreciation method. There's only going to be one in this class, and it's going to be straight line. Okay, so when you see SL, that's just straight line depreciation, and just know that when we talk about the term depreciable cost, okay, when we say depreciable cost, just know it's its original cost minus its residual value. So in the example of those white trucks, those white Ford Rangers from O'Reilly's, let's say they paid $5,000 for them. Okay, this was in 1995 when they bought them. And they say, I think we can get $1,000 for them in 2005 when we sell it. Right? This is what they think they can get. And remember, this is what they think. Okay? Then our actual depreciable cost is going to be $4,000. This is what we depreciate. Okay? Okay? So just think of it in terms of that. And when we come back on the next video, we'll try to get things pretty close to wrapped up, and we can move on to Chapter 8.